Welcome to the Organized Investor Podcast with Jerry Goodman and Megan Hubbard from Tennessee Wealth Management. Think of these pod classes as a college of knowledge, and the curriculum is an inside look at how we work with our clients to organize their investments, their retirement, and their affairs. Our process is certainly not the only approach, but it has served our clients well. Listening may materially improve your life as well, but for that to happen, it also takes an open mind, an interest to learn, and your trust in what we're sharing. We focus only on what is relevant and will explain things several times in different ways over multiple classes to ensure you understand their importance. We suggest you subscribe so you'll receive reminders about the next class. And with the tools and information on our website, theorganizedinvestor.com, you can start getting organized right now.
Welcome back, students, to what is our 24th and last pod class. It's kind of sad. We're going to release 24 for now, though, okay? So we might change our minds. We might come back. We might make a comeback. But in these 24 episodes, we have covered a lot of information. So surely you've had enough information to keep you busy for a while. And we hope that this information has helped you organize your investments, your retirement, and your affairs. Since the content is rather timeless, you can listen to it whenever it's convenient. I mean, if you really wanted to listen to us every night before you go to bed, you could do that even. I'm Megan Hubbard, along with my dad, Jerry Goodman, and students, we are glad you're able to join us today. I'm a former first grade teacher at the Christian Academy of Knoxville, and I have a master's degree in curriculum and instruction. And I'm here with my dad, Jerry Goodman, who actually graduated in accounting from Tennessee and was on the professional staff of Price Waterhouse, and was also the comptroller of Wendy's of Knoxville, which involved more than just eating hamburgers.
Right. We had French fries too.
No, and Frosties. Did you get French fries in the Frosty?
No, you could freeze them though and eat them later.
Oh my goodness. Well, he's also been a CFP with 42 going on 43 years of experience. So that's probably the most important piece of history in his timeline, I'd say.
That sums up some of the important things. And in the last pod class, which was 23, we summarized retirement planning from way back in pod class number 3, and estate planning, which we also covered in pod classes 4, 5, and 6. And as we've mentioned before, getting your affairs in order, it's important, but regardless of who you use and how much you spend or save doing any of that, that's not going to materially impact your financial life, which is what we're going to talk about in this episode. It's a summary, okay? In this, our last pod class, for now, we're summarizing the topic of organizing your investments. And for this topic, it may be possible to dramatically improve your long-term financial future. That's what we're going to talk about.
Pod class number 7 was actually the first on the topic of investments, and the first time we actually mentioned the Organized Investor Reference Guide and Portfolio Snapshot, which is on the investments page of our website, theorganizedinvestor.com. And this is a 38-page summary of many of the things we cover in these pod classes, and includes very detailed information about how we manage investments and, the reasons behind why we manage things the way that we do.
We illustrate how you may be able to improve your overall performance by 2% a year with lower fees and costs, and by simply being more selective with your investment choices. In the reference guide that Megan just mentioned, it displays our true inner nerd self because it has statistics, charts, rates of return, and it is sure to fill someone's need for facts and figures.
And starting in pod classes 11 and 12, we explained how a 2% improvement may be possible as we shared the actual net rates of return for all 190 advisory accounts we've been managing for 1 year, 3 years, 5 years, 10 years, and since each account was started. Now, we didn't literally name off 190, so if you go back to that episode, don't get scared that you're going to have to listen to 190 accounts being rattled off. But we shared all of these numbers in pod classes 11 and 12, and in the interest of time, we're only going to mention the 5-year track record because it's long enough to be reflective of what is possible with this strategy and short enough to include a larger number of accounts.
So of the 190 total accounts that we're talking about, 84 of those accounts have at least a 5-year track record through January of 2024. And the net rate of return was 14.06% per year. Now, just to be clear, that 14.06 return is net after any kind of fee or expense, and it should be easy for a listener to make a comparison to see, hey, versus your own investment to see if you have some room for improvement. Now, since our main goal has always been to improve someone's overall performance by 2% per year, for $1 million portfolio, that's equivalent to an increase of $20,000 per year or $400,000 over a 20-year period. And for some, the improvement may be even more than that, depending, of course, on how their investments are currently being managed.
Okay, so when you peel back the onion on that 2% improvement, usually 1% will come from lower fees and expenses, and the other 1% is from better investment performance. And we've divided this into 3 parts just to make this easy, okay? So first, concerning the lower fees, we're going to assume that you have a financial advisor and that you're set up in an advisory account, okay? Your financial advisor has set you up in an advisory account, and you are being charged a fee, either monthly or quarterly, based on the size of that account. Now, we also use advisory accounts, and we compared to the 15,000 advisors with our clearing firm, which is Wells Fargo Advisors. And, what they are charging is on average about 1/4% more than what we charge, okay? So reducing your advisory fee by 1/4% is not a massive savings by any means, but for $1 million portfolio, it's a savings of $2,500 per year, okay? That's also not just this year, but also next year and the year after and the year after and the year after. You get the idea here. That's a lot of money that compounds to a bigger piece of money.
It adds up over time. And so that was the first one. The second is avoidable expenses. And if your advisor has mutual funds or exchange-traded funds in your account, it can add another whole layer of internal expenses that can be as much as 1% per year, and they're buried inside of some of these investments, but you just can't see.
On the investments page of our website that we've mentioned before, there's a summary of a mutual fund advisory program that's available through Wells Fargo Advisors, and that program is called FundSource, and it's actually dated March 31st, 2024. So in addition to the advisory fee, page number 7 shows the hefty internal costs for that program at 0.78% per year. So someone with $1 million in that mutual fund model is being charged $7,800 per year in internal costs. That's like a trip, people. That's equivalent to $156,000 over a 20-year period. If that, $7,800 sounded bad, think of $156,000. And 20 years goes by fast, friends. Fees and expenses can be either those you're willing to pay, those you're not willing to pay. And these types of mutual fund costs are fees you didn't even know you're paying, okay? So in contrast, we try to avoid the internal cost of the mutual funds by focusing on actual common stocks of large, well-run companies that, don't have an internal cost to own them.
So third is about improving your investment performance. Now, on page 5 of that same FundSource summary that we're talking about are the rates of return, which we actually feel are pretty mediocre for an aggressive growth model. Now, the 5-year gross performance that's shown there is 8.94%. And assuming that a 1% advisory fee is deducted, it would bring that 5-year net rate of return down to 7.94%. Now, as we mentioned a second ago, we have 84 advisory accounts that have at least a 5-year track record, and they have had on average a net rate of return of 14.06% per year for that 5 years through January 2024.
So we admit to comparing FundSource to our results with slightly different ending dates, okay? But our 14.06% performance is 77% greater than the 7.94% performance of FundSource. That difference is a big enough difference to, drive a trip through it. And why we feel improving your overall performance by 2% per year is actually possible, depending, of course, on, how you're currently invested. Now, your advisor may have you invested in something similar to FundSource at their firm, but with a different name, possibly. And it may also have mediocre returns.
So Why the big difference in our returns versus fund source? Just to bring this up. Well, in addition to avoiding the internal costs of fund source, part of that mediocre performance is when you're invested in, let's say, 15 mutual funds that each of one may own 200 companies in each fund, you're effectively invested in, let's say, 3,000 companies. You have gone from diversification to diversification,
Dun,
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 dun, dun, because you effectively own virtually every stock on the planet. So, yeah, you not only own the good ones, but you also own all the bad ones along the way.
You about didn't get now I'm tongue twisted.
Yes.
Diversification.
Don't be diversified.
You would think by episode 24 we could get that word correct.
Yeah.
Well,
Not us.
we're just keeping them on their toes, making sure they understand what we're talking about. Well, we think a much better approach to all of this is to focus on a higher quality individual stock or stocks, if you will, with a history of raising their dividends. Okay. And we refer to this strategy as dividend growth. These types of companies have significantly outperformed many parts of the stock market for decades, actually, and usually with less volatility. There's no internal cost to own individual stocks versus mutual funds and exchange traded funds. And stocks are also more transparent, so you know what you own. Stocks let you be more selective. They're more transparent, like I just said, and they give you better control over your taxes.
So, in terms of the performance of this type of dividend growth strategy that we're talking about, let's go back to, again, on the investments page of our website is a performance summary of something called the DSIP list, DSIP. Now, DSIP is a research list from Wells Fargo Advisors, and it stands for Diversified Stock Income Plan, or DSIP. And it's very similar to the dividend growth strategy that we use for our clients. Now, DSIP has an impressive track record of 12% per year going back to 1993, so it's a 30-year track record since its inception date. And that 12% track record is made up of, let's just kind of break it down, maybe 2 to 3% of that return has been from the actual dividend income. The rest of it is simply appreciation in stock price. And oh, by the way, that 12% return is about 17% per year better than the S&P 500 index. And it's done better with actually less volatility.
Also, on the same page of our website is a Ned Davis research study that demonstrates the same level of outperformance for this type of dividend growth strategy over an even longer period of time. And of course, we just explained the average net return of our 84 advisory accounts of 14.06 per year through January 2024.
So our outperformance versus the fund source example, for example, and many other mutual fund advisory programs as well, is due to avoiding the internal cost of the mutual funds and by simply being more selective with the investment choices. So this includes this dividend growth strategy and these stocks that have a history of raising their dividends.
Also on the investments page of our website is a summary titled Consecutive Dividend History of the DSIP List. Riveting, right? And as the name implies, it outlines the uninterrupted dividend increases for 13 companies from the list. Now, here's a few names from the list you're going to recognize. There's McDonald's, and they had 46 consecutive years of dividend increases. Johnson & Johnson, all those Band-Aids and baby shampoos that you're buying, 60 consecutive years. Colgate-Palmolive, 60 years. Lowe's Home Improvement, 61 years. Emerson Electric, 66. And Clorox, 46 years.
Probably recognize every one of those. And those are just a few examples from the DSIP list. That list will usually include about 70 to 80 stocks at any point in time. Now, because these are all very well-managed companies with a history of growing their business and increasing their dividends, they're very attractive to investors, which explains why the excellent performance over long periods of time and why it's outperformed even the S&P 500 index.
So let's go back to the fund source example again, because, there's another reason why these types of mutual fund advisory programs may actually have mediocre performance. And once again, on the investments page of our website is a summary titled Pay to Play. We're showing the relationships between investment firms like Merrill Lynch, Morgan Stanley, Wells Fargo, Edward Jones, UBS, et cetera, et cetera, et cetera. I could stand here and name a bunch. And the product and the service companies like American Funds, Putnam, Federated, T. Rowe Price, Hartford, Fidelity. The list could go on.
On the second page of this summary are website links where these investment firms have disclosed their financial relationships with these product and service companies. Now, much of this may even be included in the paperwork that they're going to send to their new clients, but that doesn't mean many people are ever going to read it, much less even understand it. So these disclosures explain the payments that are flowing from these same product and service companies that we mentioned back to the investment firms that invested the money initially. That means that the mutual fund companies are sending payments back to the investment firms in return for investing money with them. And these payments are usually referred to as maybe revenue sharing or perhaps cost reimbursement. They have different names that they'll apply to them.
And much of this money will actually come from the internal costs of the investments themselves, like mutual funds or exchange traded funds. Someone with $1 million in that same fund source model is actually paying $7,800 per year in internal costs to the mutual fund companies. And part of it makes its way back to the investment firms that made the investment selection. Okay, are you following this trail here? Some investment firms openly admit they won't even include a mutual fund or an annuity on their platform unless they receive money from those same companies.
You're quickly climbing the learning curve by listening to our Organized Investor podcast. Your instructors are Megan Hubbard and her favorite dad, Jerry Goodman. Listening to at least 12 pod classes is recommended, and it also helps to subscribe on your podcast platform.
So as you might expect, this is called pay to play. You might have heard it for other scenarios in different industries because these product and service companies have to pay for their investment products to be available at or maybe even recommended by these investment firms. Now, in addition to these disclosures of these hundreds of millions of dollars that are being transferred around, it's common in these disclosures to also see the term conflict of interest to describe these arrangements. And one firm, actually, and I won't mention which firm, referred to it 14 times.
What an investor should be concerned about is if their investment firm is making decisions in the best interest of them, the client, or making decisions based on which product and services company is sending their investment firm the most money. Okay. This is where possible conflict of interest comes into play. And, just one more reason why we try to avoid advisory programs invested in mutual funds and ETFs.
Now, in case you're wondering, yes, your financial advisor knows all about these pay-to-play relationships. And no, they will never bring it to your attention. So take a look at the document on our website. It's called Pay to Play on the investment page of the website. And it's really kind of interesting, maybe not shocking, but it's interesting to read what they actually have put in print.
So in pod classes 16, 17, 18, 19, and 20, we actually covered the fact that this dividend growth strategy has been very successful. And we continue to harp on this for 5 episodes because it took about 6 months for this to sink into my dad's thick head. Okay, I won't say mine, but definitely his.
Well,
that was
better thick than empty, I guess.
I guess that's why we kept repeating it. So now, as good as the returns are, the most common objection to our approach is the fear of missing out, which is referred to as FOMO. Some of you might know that. I found that out from my teenagers.
FOMO. So people have said, they'll say something like to us, your strategy really has really good dividends every year, and the companies have really nice appreciation, and we can reinvest the dividends if we wish, and it helps to, say, mechanically withdraw money during retirement, so it really works well. So yeah, Jerry and Megan, you're right about all that. But hey, what if some stock out there, what if it goes from 30 to 400 and I miss out on that? That is the most common objection to our strategy. And our response would be, yeah, you're right about that. And something will go from 30 to 400. The problem is you don't know what it's going to be. You'd like to buy the winning lottery ticket if you knew the number, wouldn't you?
Yeah, I would. So on the investments page of our website, there is a summary titled FOMO, F-O-M-O, and it shows the return of the NASDAQ for a 20-year period of only 11.7%, okay, which is an average of only 0.6% per year. And we admit to cherry picking the dates to make a point here, okay? But if you retired in March of 2000 with your retirement nest egg invested in this part of the market, you'd have very little to show for it over the next 20 years, okay? In fact, after the tech bubble burst around March 2000, it took about 17 years for that sector to make back what it lost, okay?
So maybe you've thought this, maybe you've never had this mentioned to you, but you only get one chance to plan for retirement and to be retired. So maybe you want to think a little bit about how much risk you're willing to take by investing in what you hope is going to be maybe the next Apple or the next NVIDIA that's going to make you a zillionaire. So instead of looking for that needle in a haystack, we're going to share with you what we think is a much better idea to get some extra return, even to complement what we do use with this dividend strategy. Now, once again, back to the investments page of our website. There is a summary there by Hartford Funds titled 10 Things You Should Know About Bear Markets. And it explains that a bear market is a decline of 20% or more. A market correction is a decline of between 10 and 20%. And a bull market, that's a 20% or above increase from its recent low.
As you listen to this, you may be thinking, how does this really help me? And the answer is it probably won't if your portfolio is being managed like some of the others that we've mentioned here and that we see on a daily basis. We've been continually harping on the fact that this dividend growth not only has a better long-term track record than the S&P 500 index, but it also has less volatility. So in simple terms, they don't fluctuate as much as, many other parts of the market might.
So when you get a correction or even a bear market, having a portfolio of dividend growth stocks that probably didn't drop as much as the rest of the overall market, it gives you a chance to take advantage of what we're going to refer to as a bargain opportunity, okay? Now, these may not be appropriate for every client, and not every client may be interested in them as well.
And every bargain opportunity is going to be different than every other one in the past. There is no way to know what the next opportunity is going to look like and when it may pop up, okay? But here's 2 examples in the last few years of some bargain opportunities that have popped up.
So the first bargain opportunity was in March of 2020, which, if you may recall, that's when COVID reared its ugly head. So stocks went into an immediate bear market almost. It only lasted 33 days. But it dropped 33% in value very quickly. Now, about a month later, things calmed down some. So I began having conversations with clients about moving some of their money from those stocks like Smucker's Jelly that maybe were down 2% into some of these other great companies that had dropped as much as 75% or more. Now, these are stocks that, as you might imagine, they included hotels, restaurants, casinos, airlines, cruise lines, theme parks, movie theaters. I mean, it was about anything that was hospitality or travel related. That's where all the opportunities were.
And for our clients who were interested in this opportunity, we basically reduced their allocation in the dividend growth stocks that had fallen very little and into a larger number of COVID stocks that had fallen a lot. So for most accounts, half of it was now the dividend growth stocks they already owned, and the other half were the companies affected by COVID.
So obviously, the COVID crisis went away, I guess, although people still have COVID, it seems like, even to this day. And if you're curious about how much money was made from this little approach, I'm going to only say that it was a lot of fun because it was very profitable. My only other comment is that about 18 months after we did all of this, I was then having discussions with CPAs of several of these clients just to forewarn them just how much gain that they were about to realize in 2021, and if we needed to have some of it deferred into the following year, which is 2022.
Surely people didn't get mad, though, about making money, even if you have a bigger tax bill.
Well, but some people just are really averse to taxes, but that's the bad part about making money, isn't it? There's worse things than making money.
That is true. So the second bargain opportunity that we're going to share with you happened in March of 2023, actually, when several large regional banks actually failed due to a liquidity crisis caused by the rise in interest rates. And as you would expect, many other regional banks also dropped sharply in price due to the fear that others might fail as well. So research indicated this was not going to be an issue for regional banks as a group, and it ended up, being corrected, if you will.
So we repositioned some of this money, again, from these dividend growth stocks that had not really fallen very much into 13 different banks that had gone down a lot. And these were banks, many of them you're going to recognize, like Regions Bank, First Horizon, Pinnacle Financial Partners, Truist, and a number of others. Now, every one of these stocks, they all paid a nice dividend, so it really wasn't much different than every other dividend-paying stock they already had in the account. But the big difference was the price we paid for these banks was off a lot from their annual high, which made it a bargain opportunity. And yes, it was also very profitable.
So just to be crystal clear, though, dividend growth is our core strategy, and we feel it's the best approach to improving someone's financial future. Think about our dividend growth strategy as the main course and the most important part of the meal, right? Like the hamburger and not the French fries that are the side part of your meal. And these bargain opportunities, they're like the dessert that's served up on occasion, like the apple pie that you every once in a while get when you go through
or strawberry shortcake. Or strawberry shortcake.
Not for strawberry shortcake.
Not from McDonald's. I know, but I'm thinking better restaurants than McDonald's at the moment.
That's true. Okay. Well, I mean, anyways, so we're trying to summarize 40 years of experience into a 40-minute summary. And we're not only glad you've joined us, but we think you're lucky to hear all of this, really. And someone in Jacksonville, Florida was lucky enough, I don't know if you knew this, to have purchased a winning Mega Millions lottery ticket in August of 2023. It was worth $36 million. Okay. But wasn't lucky enough to know it was their winning ticket because the prize was never claimed and was forfeited 6 months later.
No.
Still, like, can you imagine if you found the ticket?
You would hope that
6 months and a day later.
Yeah, your big fear is someone had found out that you'd done that.
Oh,
and
I would kill you.
You'd be ridiculed for the rest of your life. So here's the takeaway from that missed opportunity. Think of your portfolio as a lottery ticket that you already own. You don't have to go buy it. You already have it. And these pod classes will help you know if your portfolio has that winning number. Now, if someone has $1 million portfolio, if they can improve that performance by just 2% a year, we've said this before, that's equivalent to $20,000 per year, $400,000 over a 20-year period. So sure, that's less than $36 million on the lottery ticket that we just mentioned, but the odds you can significantly improve your financial future are much, 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 much better than 1 in 302 million, like the lottery ticket.
And if you need some help finding out just how much room for improvement your portfolio has, we're offering to help you without any cost or obligation, okay? We're going to close our last pod class for now with the story about Bruce that we explained not too long ago in podcast 21. And this is a great example of probably 80% of, everything we've ever covered in our pod classes, really. And after attending a live workshop, Bruce said his goal was to have his estate planning attorney, his tax advisor, and his financial advisor all know and work with each other to make his life easier. We all want our lives to be easier, right? And that's exactly what Bruce has now.
So Bruce now works with Jared Hubbard, my son-in-law, who happens to be married to Megan, who's on the podcast with us. And he is a practicing CPA on our team. And he's been doing Bruce's tax returns shortly after we first met him, okay? Bruce also has an estate planning attorney that works with us on most of these cases, and he's helped us on hundreds of them over the past decade. And we're well aware of how everything is structured in Bruce's situation in case some changes need to be made along the way. And oh, by the way, for what it's worth, Bruce probably saved several $1,000s versus working with this attorney, with our attorney that we work with versus doing this on his own.
So the estate planning and taxes are pretty straightforward. But what isn't so obvious is how we've been able to help Bruce with organizing his investments. After Bruce gave us his information, the single biggest surprise was that we could save him $9,800 per year in just advisory fees, because not only do we charge less than most advisors, but some of his accounts didn't even need to be an advisory account. Like, what in the world? It's like hand to face. Can't believe that when we saw that. Now, keep in mind, this is just from the reduction or the elimination, if you will, of the advisory fees that he was being charged. This didn't even include, any sort of gains in his account just from what he was invested in.
Exactly. And when we shared this with Bruce, I swear to goodness, he said, I don't believe this is possible. So we went through every single account one at a time, page by page, and explained what he was being charged in this account, the next account, and on and on and on. So Bruce is super smart. He was very good at math. That wasn't the issue here. He just didn't understand the fees and what was reasonable and what was possible and what should have been done. he had trusted his long-term advisor he'd been looking out for him, looking out for Bruce. That obviously wasn't the case. So the $9,500 was just either the reducing or eliminating advisory fees, that's pretty incredible. And since this is an annual savings, let's once again extrapolate that out over a 20-year period. Again, that's also equivalent to about $200,000. And that's if you don't even assume any appreciation. That's just pure assuming that it stays the same value.
And in addition to the advisory fees, we actually showed him the internal costs of the many mutual funds he owned and also the mediocre performance that he had gotten from them. So this was like the cherry on top of his sundae when he heard that he was paying $9,800 in fees. And now he also has, advisory fees in these these internal costs in these mutual funds. This was even more financially beneficial, actually, than reducing the advisory fees. And, I don't know what Bruce would have made from his mutual fund advisory strategy he was originally invested in, but I will share the fact that his 5-year net rates of return of our dividend growth strategy we managed for Bruce is actually more than 14% per year.
So the point is that he materially improved his long-term financial future that will either help him personally or flow down to his family. So Bruce started off, he wanted his legal, tax, and financial advisor to all communicate with each other to make his life easier, which is what he thought. This is where he is. But what he didn't even ask about was improving his overall performance. And that's what he got, which was basically, as Megan is using the example, the cherry on the top of the ice cream.
And, we have lots of happy campers. We could share lots of stories like Bruce, along with their families who will benefit from all of this, either down the road or, maybe now if these ideas make sense for them personally. And helping educate these families of our clients is actually one of the several reasons we've created these mini pod classes.
So if you've listened to many of our other episodes, you know that our favorite part of these pod classes is always explaining that rates of return for each of our clients' accounts can vary based upon the client's individual circumstances, such as when they started the account, what the investment objective was, et cetera. So these rates of return for our advisory accounts, they were compiled from a month-end performance report for each of those 190 accounts, respectively. And we also have a lot of boring documentation to back all this stuff up if someone wants to come by and we'll share it with them.
So this is podcast 24, which is a summary of the many episodes about organizing your investments. You're invited to listen to any of our podcasts and to view the video on our website and to call us with any questions that you actually might have and want to discuss in person. And an even more productive use of your time is to actually sit down with a no cost, no obligation discussion about your situation to see if working together would make sense. Be sure to follow us on social media such as YouTube, LinkedIn, X, and save us to your favorite podcast player to receive reminders of future episodes. Thanks for listening, and class is dismissed.
Half-like.
The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of the organized investor or TN Wealth Management. The content has been made available for informational and educational purposes only and is not intended to be a substitute for professional investing advice. Opinions expressed are subject to change without notice and are not intended as investment advice or solicitation for the purchase or sale of any security. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning or before making any investment decision, and please consult legal or tax professionals for specific information regarding your individual situation. The organized investor cannot accept trade or account instructions on or through this platform. Please contact us directly at contactus@tnwealthmanagement.com or 865-415-2060 to place a trade or for trade or account-related questions. Brokerage and advisory services are provided by TN Wealth Management through Prospera Financial Services, Inc., member FINRA SIPC. The organized investor is a brand name operated by TN Wealth Management for educational platform purposes.